वाइट शर्ट को बना दे स्पेशल और फैशनेबल। फॉग सेंट, न्यू फैशन वेयर फॉर मेन।
Hello and welcome to the special programming on Bloomberg Quint. The global sell-off continues with global equities witnessing their sharpest correction in years. Let's take a look at how the markets are faring at this point of time. The Nifty is down almost close to 3% at the lowest point of the day. The Sensex is closing in again on close to the 33,400. It's below the 33,400 mark, and the Nifty Bank is closing in on the 25,000 mark. So there seems to be a partial recovery that's come in, but nevertheless, the markets have been rather weak. What's leading the fall on the Nifty? Some of the counters which have cracked significantly. Tata Motors is down 6%, post a very weak set of numbers. GAIL and Axis Bank are down in trade. Indiabulls Housing Finance, which was one of the worst performers over the past few days, is down almost 4%. So across the board, all the stocks are falling. The best of the Nifty stock is BPCL, but that is also down over 1%. So that's the trend that we are getting in as far as the market is concerned. As per the global trends, there is a sell-off, but there are some stocks which have managed to survive the sell-off over the past 5 days. Yatin's here with that list, because what we've seen is that for the past 5 days the Nifty has been down, but the selling has intensified, Yatin, in the past 3 days. But what's happened in the past 5 days, if you can tell us, with respect to certain groups like the Nifty Bank, what's going on?
Well, if you look at the Nifty index, clearly you can see a sea of red in the last 5 days, barring Tech Mahindra, Bosch and Eicher Motors, which are up in terms of the marginal gain. Look at the losers list. We have Indiabulls Housing Finance, Tata Steel, ONGC, Dr. Reddy's and ICICI Bank. All of these stocks tumbling over 10% in trade in the last 5 trading sessions. Of course, we also have the financial services, and that is the bulk part here. Over 9% cut coming in as far as SBI, HDFC, Axis Bank. You are mentioning the fact that today also is one of the top losers, ICICI Bank. So all of these stocks have been battered down. Of course, we also have Asian Paints, Mahindra and Mahindra, BPCL, which have outperformed, but clearly are trading with losses, especially over the last 5-day period. So clearly, this is the scenario as far as the Nifty is concerned. And look at this Nifty Bank Index, the kind of battering that we had seen, almost 1,000 points today, down today as well. 7.5% cut is what we are seeing in Nifty Bank in the last 5 trading sessions. However, if you look at it, the fall is coming in really from the PSU banking space. So we have Canara Bank, PNB, SBI, all of them down anywhere between 11 to 10%. Also IndusInd Bank, Kotak, Yes Bank, HDFC Bank, all of these banks have seen cuts of nearly 5 to 7%. So when it comes to the banking space also, the situation is much weaker than the large cap frontline stocks. So banking has seen some weakness, which is much higher and much severe in terms of the correction that we have seen in other large cap stocks.
Yeah, but I was seeing this mail from you in which you said that bulk of the stocks in the 52-week low are from the BFSI space.
Right.
Can you highlight them?
Well, if you look at the likes of IDFC Limited, and the list is quite long. So clearly all of these stocks are moving down. So it's SREI Infra, Max Financial, Aditya Birla Capital, IDFC. These are the private BFSI participants, wherein we have seen the share price touch a fresh 52-week low in trade today. When it comes to the financial services space in the PSU segment, we have PFC, LIC Housing, which have touched a fresh 52-week low. And surprisingly, after the bank recapitalization plan, we have seen sharp surge coming in as far as most of the PSU banks are concerned. But look at the scenario in a couple of months. We have a long list of PSU banks coming in. So Dena Bank, UCO Bank, Syndicate Bank, Central Bank of India, Indian Overseas Bank, Corporation Bank, and the list is long. Union Bank, Punjab Sind Bank, Oriental Bank of Commerce. All of these stocks are trading at a fresh 52-week low, despite despite the fact that we had some reforms coming in on the banking side. So clearly, we can understand the kind of weakness that we are looking at as far as the entire PSU banking lot is concerned.
Okay, many thanks for that, Yatin. But we have some global voices which have spoken. Jonathan Garner of Morgan Stanley believes that the recent market correction is not a 1 or a 2 day phenomenon, but a more long-lasting one. Here are a slice of the conversation he had with Bloomberg's David Inglis earlier in the day.
I think there's a lot of loose talk around like a healthy correction. I think you have to be very specific about which markets, and you need to look at how valuations adjust. So we're actually just moving below our base case target for Japan today. That's adjusting more quickly. Topics. For Hong Kong, yesterday we had the very strong southbound flows, which actually cushioned the adjustment, but it's selling off heavily now. So again, just starting to move below our base case target. But I suspect we need to see a correction that is meaningful enough to establish something like 5 to 10% upside to base, particularly when you bear in mind the way that some of the quantitative strategies, systematic strategies are starting to unwind, and just how extreme the investor euphoria was going into all of this. So I doubt very much that this is just going to be a 1 or 2 day phenomenon. I suspect it's going to be more long lasting.
How deep will this correction be? And there are views out there that it is just a correction. This sell-off will be short-lived. Are you of that view? I mean, you said that perhaps not the next few days, but how deep will it be?
Well, I touched on the idea that Japan is moving faster through this correction than elsewhere, but the deeper problem for Asia is we're a tech-heavy region, and we downgraded the semis and tech hardware space last November, and last night, just before the US Open, and our US strategy team did something similar. We downgraded tech overall, including the internet names. So that's very important for us here in Asia, and it's really there where the valuations have been at their most extreme, and where we're starting to see earnings revisions moving south. And again, that speaks to the idea this is going to be quite a long-lasting correction. So I think where's defensive, actually you were covering the markets in Singapore. I think ASEAN, Singapore and Thailand, that's not over-owned, it's not tech-heavy, it's actually speaks more to the upstream energy sectors. I think those markets can be somewhat defensive in this sell-off, and we think North Asia is where the price action will be most severe.
Jonathan, I want to touch on volatility, the VIX. For a very long time, people were saying, where is VIX? Where's the volatility? Now we see the volatility spike the most in a very long time. What do you make of that, and how do you play this?
I think if you just looked at VIX as a one-factor model, it's obviously moved to like the high 30s, then you'd say, sort of, wow, that's extreme, so, lean into it. However, given everything else we talked about so far on that interview, I really wouldn't just use that as a single factor. And what we don't know about is the way in which these kind of volatility suppression strategies, these quantitative and systematic strategies now get into difficulties. And there are some signs around that. So, yeah, VIX is high, but I wouldn't use that just as a simple reason to say, like, let's buy the dip. This is not a buy the dip situation. It's a far deeper problem around valuations and earnings outlook.
Okay, it's a technical sell-off, says Mohammed Apabhai, the head of equity strategy at Citigroup Asia. Speaking to Bloomberg TV, he says that the low volatility had also prompted investors to take bigger positions, which may have triggered the sell-off. He does expect the sell-off to continue for some time more. Let's listen in.
We did some analysis which is called the quantum tunnel, and the lower end of the tunnel was 2,700 on the S&P, and when that broke yesterday, you saw a very sharp rise in the VIX. This is actually quite a technical sell-off. What we've seen is a rise in volatility. That rise in volatility it's sort of in a way that we've never really seen happening before. It's because there's been a lot of people over the last 5 years sitting there selling volatility for income, and as that resets higher, basically what it means is that positions have to be taken down. So we think that overall there's probably another 5% lower in this market. We're watching very closely now for the reaction of the central banks. Your previous speaker was talking about China. That's going to be very important in Hong Kong today to see what southbound flow does. But we think 5% lower. The markets will be looking for the central banks to react and come out with some sort of statement.
Do any of the data matter today? I mean, we have the RBA later on on, or is today one of those days where you essentially take everything, you throw it out the window, kitchen sink and the baby, and just let this one settle for the moment?
Yeah, I think what's important to remember is that certainly the fundamentals remain fairly strong. So it's
Do those things matter though on a day like this?
On a day like today, it's more about positioning. But saying that, you know, just coming off the trading floor right now, the long-only funds are very calm. In fact, our pad was actually better to sell in Japan in the morning. It's actually turned neutral to slightly better buyer. But I think that the long-only funds will probably be watching from the sidelines initially as they decide what to do. Remember, this has all happened within the space of about 2 or 3 days ago. I mean, even when I look at the commentary I get in my inbox, people were talking about another 10-15% higher even 2 weeks ago, and now, you know, we're looking at where we're going. The thing is that earnings revisions actually followed the market up as well, so it'll be interesting to see what happens with those earnings revisions. But really what we are looking for is some indication from the central bank, and I think if Mr. Powell wants to speak, then 5% lower. I think he should get a call from the White House or something.
What a great first day on the job for Joe Powell. But it also makes me scratch my head when people say the fundamentals have changed, because I've got to wonder what's changed in the last 2 days when the bulk of the sell-off has happened on a day when we haven't had any macro indicators, least of which ones that have surprised to the downside. But I want to throw up this quick chart. This is G#BTV611, and it just shows kind of how unusual, how aggressive the sell-off was for the S&P, right? We've been saying this was the worst route that we've seen at various other points, worse than what we saw after China devalued its currency, worse than after Brexit, worse than after the US election, in terms of not seeing these 2% plus moves to the downside very often at all. In fact, we didn't see that pretty much all last year. We saw that that's pretty much close to where we had the election. But what accounts for the violence of the move, Mohammed? Is it just the fact that we've come from such a peaky level?
I think there is partly that. I think I was on your show yesterday talking about the idea that markets don't go parabolic forever, and when the day of reckoning comes, then, you know, things are a little bit more interesting, let's say. I think what's also interesting is that this move has got to be put in its appropriate metric, which is that you've got to measure it relative to how many standard deviations it is away from zero, really. And at a low volatility environment, people's positions get larger. Really, as that volatility rises, what it necessitates is for that position to be unwound. And if you want to have a look at really how concentrated those positions actually were, you only have to look at something like the XIV inverse VIX ETF to really see what's been going on in terms of that volatility selling. So I think at the moment it's going to be very technically related. I mean, we're seeing really positions being taken down. We've seen very high short positions in Treasury bonds. We think some of those will get unwound as well. But generally, just a bit more circumspection into the market, and we do think 5% lower from where we are right now, if we can get down there, will present potentially the first big buying opportunity of 2018.
We're actually looking at a 3 sigma move today. And, you know, when I look at something like this, for example, and that leg that you see lower, MSCI Asia Pacific here, by the way, just in case, and you look at the extreme moves that you're seeing on the long end of the curve, say over in Europe, to your point, escape velocity in the economy, we're not yet there for inflation, which tells me the bond markets might have just overshot. Yes. Over in Europe. Where's the mispricing right now in fixed income?
Yes, so my view has been, and I don't think this is a very popular view, but my view has been that the bond markets are actually very cheap, and I think we highlighted that last week as well, saying that, you know, certainly at 3%, bonds would look very interesting. The question at the moment really is, and this is the really big question for investors, is do they believe that if the central bank liquidity was withdrawn, that the global economy would continue to rally? What we are seeing is actually a 97% correlation between global equity markets and our measure of central bank liquidity, which you can also track on Bloomberg under the ticker CGCTGBAL. Now, if there really was this escape velocity, then that correlation would be starting to break down. And so far, we've not seen any evidence of that. So if that is the case, then what that would indicate is that going forward, some of these macro numbers may actually start rolling over, and we're going to need more help from the central bankers yet again.
Okay, and joining us on the show now to give a broader view on the market sell-off is Jim Rogers, Chief Executive Officer at Rogers Holding. Good morning, Mr. Rogers. First of all, what reasons do you attribute to this global fall that has happened?
Well, the stock markets around the world have been going up a lot in the last few years. In the U.S., for instance, there's not been a big correction for a long, long time. It's a very unusual what happened in the American stock market. It is overdue for a rout, and now we're having one. Whenever there's an overdue correction, people always find reasons. I can give you some reasons. The main reason is that it had gone up too long, too far, too fast. But interest rates are going higher. There are problems in Washington with the government, with the politicians. There are many reasons. But essentially, it's because it went up so long without a correction, and now we're having a normal correction.
So what does it mean for emerging markets like India, this correction that has happened?
If you're talking about India, first of all, nearly all markets will be affected. As you know, China went up yesterday despite all this, but nearly all markets will be affected in the same way, especially India, because Mr. Moody's now coming up with a capital gains tax. And whenever you tax something that presents a problem, there's less demand. So you now have the problem of having gone up a long time for a long way, and now you have a capital gains tax. So India will probably be worse affected than other markets.
Mr. Rogers, do you expect further fall in India because of the long-term capital gains tax that has come in?
Yes, to repeat, whenever you tax something, whether it's salt or cars or anything, alcohol, whatever it is, there's less demand. People don't like paying taxes, and especially in a country where they haven't had to pay a tax before, it's going to cause uncertainty, if nothing else, and less demand.
So now, do you view commodities as a relatively safer haven?
Well, agriculture is down a lot over the past several years, so I would consider agriculture less vulnerable and perhaps even a place to make money on the upside because things have been down for so long.
Okay, so that's the view that's coming in from Mr. Jim Rogers. But finally, before you go, sir, other than agricultural commodities, any other commodities that you would place your bet on?
Well, agriculture, I mean, I don't know what was unclear. Agriculture, sugar, buy sugar. Everybody hates sugar at the moment. Or you can also look at U.S. dollars as a safe haven. The U.S. dollar went down a lot last year, and in times of turmoil, people often turn to the U.S. dollar as a safe haven. It's not, but people think it's a safe haven.
Okay, taking cue from that, finally, what's your view on global markets given that the fall that we've seen? What do you expect now?
What I would expect to happen is for the markets to go down to, I don't know, February, March, into March at least, when the Federal Reserve will raise taxes, will raise interest rates, I mean. Once that happens, the markets will probably have a nice rally. Then we'll have to see where it goes from there. But, you know, ultimately, the U.S. market's been going up since 2009, so the U.S. market is very, very vulnerable to a bear market. We usually have bear markets every 4 to 7 or 8 years. So, sure, by 2019, if not before, we're going to have a bear market again.
Okay, thank you, Mr. Rogers, for speaking to Bloomberg Quint. With that, it's a wrap on this special edition on Bloomberg Quint. We continue with our coverage with trend spotting on the other side.